Welcome to the Deep Dive, your shortcut to being truly well-informed. Right now, the markets, they're caught in this really fascinating tension. You've got soaring optimism around artificial intelligence, right? But it's battling against this growing collection of red flags in the broader economy. It's almost like looking at two different worlds at once, trying to figure out which one is, the real story.
It really is a critical moment. And this deep dive, well, it's all about giving you some clarity on that. We're unpacking the market outlook for the week of August 5th through August 11th, 2025. Our mission really is to pull out the most important nuggets of knowledge from all the material we've reviewed, help you connect the dots on what's actually happening, and maybe more importantly, why it matters for how you understand the current financial landscape.
Exactly. We'll guide you through it, helping you understand not just the headlines, but the forces underneath. So let's start with what we're kind of calling economic Groundhog Day. Those subtle shifts, the upcoming signals, they might seem quiet, but could be, well, pretty powerful.
Yeah, last week was surprisingly quiet for the big, headline economic releases, almost like that financial Groundhog Day you mentioned, waiting for the shadow. But like we often find, it's those less followed indicators, the subtle stuff, that can give you the real insight, especially when they hint at something bigger shifting under the surface. Take continuing unemployment claims, for instance.
Continuing unemployment claims. Okay. That feels subtle, but like you said, potentially powerful. What did the numbers actually show this week? How significant is that sort of whisper you mentioned in the context of the labor market?
Well, they hit their highest levels since November 2021. And what that signals is people who are out of work, they're taking longer to find new jobs. It's a quiet, but pretty clear whisper that the labor market is weakening. It suggests we might be seeing the first, let's say, cracks in what's been a very, very tight labor market. Could signal future shifts in, say, wage growth or even consumer spending. Stuff the market maybe isn't fully pricing in yet. It's that subtle shift we really need to keep an eye on.
Right. A quiet warning sign in the unemployment data. Definitely something to watch. But what about right now? What's coming up this week that we should be focused on?
Okay, so this week brings two really critical inflation reports. Could shake things up a bit. We've got CPI on Tuesday, PPI on Thursday. These are crucial because, well, they'll give us a clearer picture. Are those tariffs finally starting to bite? Are they impacting prices for consumers and producers? Then on Friday, it's kind of a double header on the U.S. consumer. Retail sales and the University of Michigan consumer sentiment, both are actually expected to be slightly stronger than last month, which will be interesting given those other weaker signals we just talked about.
And the tariff situation feels like it's always there, this constant tug of war. It obviously plays into those inflation reports. Any more clarity there? Or are we still just waiting?
Still mostly bits and pieces, really. We've seen some clarity on a few countries, maybe, but investors, definitely in a wait-and-see mode right now. The biggest question mark, of course, is still China. Any final agreement there? Until that happens, that uncertainty is just gonna, hang around.
Okay, so beyond the economic data, and another huge force, obviously, is the Federal Reserve. And there's been some pretty big news there shaping rate cut prospects, right? With a bit of a political angle, too.
Absolutely. Huge news. Trump has nominated Stephen Miran. He's the current chair of the Council of Economic Advisors to replace Adriana Kugler on the Fed board. And this is a big deal. A Federal Reserve governor spot, that's a powerful long-term position, can significantly shape monetary policy, influencing everything from interest rates to financial stability for years.
And Miran, he hasn't been shy about his views, has he? Particularly on the dollar.
No, not at all. He's made public statements. He seems aligned with Trump's desire to devalue the U.S. dollar. The idea there, of course, is boosting exports, curbing imports, trying to narrow that trade deficit. So yeah, this appointment definitely strengthens the odds for a September rate cut. A weaker dollar could sort of clear the path for easier policy.
Okay, that sounds like a pretty clear signal then. Almost seems like a done deal for September. But here's where it gets really interesting, maybe a bit counterintuitive. Despite this, the probability for a September cut actually dipped slightly this week, fell to 86.5% from 94% last week. What do you make of that little bit of softening certainty?
Yeah, it is a bit of a head scratcher, isn't it? And if you connect that to the bigger picture, the solid majority expecting 50 basis points, that's 0.5% or more in cuts for the rest of 2025. That also edged down to 86.5% from 92% last week. So it raises this question. If the signs seem to point towards a cut, why is the market's conviction actually easing off just a tiny bit? suggests there might be other signals, maybe, or perhaps just a slight recalibration of expectations happening, creating this subtle doubt.
Fascinating stuff. Okay, let's shift gears to the U.S. stock markets, because honestly, they seem to be living on a different planet right now. AI's climb just seems to be shrugging off all those economic headwinds we've been discussing.
The resilience has been pretty remarkable, actually. U.S. stocks had a fantastic week last week, especially growth stocks. NASDAQ hit another record high on Friday, and the S&P 500 is only, 0.3% off its high from back on July 28th? It's almost defying gravity, considering some of that underlying economic data we talked about.
And it really does seem to come back to AI, doesn't it? That renewed optimism is the main engine here. Is there really that much more fuel left in that AI tank?
Well, it certainly looks like it, at least for now. Our sources mentioned a quote from Wedbush analyst Dan Ives. This was in a Yahoo Finance piece on August 6th. He said something like, while the first steps in AI are NVIDIA chips in cloud companies, importantly, we estimate for every $1 spent on NVIDIA, there's an $8 to $10 multiplier across the rest of the tech ecosystem. It's a huge potential ripple effect. It's just the AI story is way broader than just, a couple of chip companies.
Wow, an $8 to $10 multiplier. That's huge.
Software using AI, the massive cloud infrastructure needed, new services built on top of it. The belief is this isn't just another tech trend, it's like a fundamental reshaping of industries. But, and this is the big but, here's that great divergence we mentioned earlier, it's a stark contrast. All this AI excitement is, for the moment, completely canceling out growing worries about the U.S. consumer weakening. It really is like two parallel tracks. Wall Street flying high on AI, while Main Street keeps flashing these persistent red flags.
Okay, so what are those specific red flags the market seems to be ignoring? And, how long can that last? How long can those two realities coexist?
Well, you've got the weak July jobs report we touched on, those higher continuing unemployment claims. Then there's rising consumer credit issues, delinquencies ticking up, and banks clearly tightening their lending standards. It just paints a very, very different picture from the stock market rally. And it raises a critical question for you, looking at your own situation. How much of this market strength is built on real economic health versus just sheer optimism about the future?
Right, so there was a Bloomberg article, August 8th, observing that this divergence kind of suggests investors believe that consumer is actually healthier than the official data shows. Is that sustainable? Or is that just a really risky bet right now?
That's the crucial caveat, exactly. And it's a massive if. The warning is pretty clear if the consumer really does start pulling back significantly, if they get spooked by these rising pressures. AI alone, no matter how exciting, won't be enough to hold up the entire stock market. The consumer's still, 70% of the U.S. economy? That's the reality.
And just to pile on, there's also that historical headwind coming up in September, right? Markets do tend to remember these things.
They do, yeah. September has historically been the weakest month for U.S. stocks. This goes all the way back to 1970. It averages a negative return, minus 0.9%. It's actually the only month with a negative average return over that whole period. It's a psychological hurdle, if nothing else, heading into the fall.
Okay, so just quickly, how did the specific market segments do last week amidst all this pulling in different directions?
Right, so large cap stocks, they were up 0.7%. Small caps up just 0.2%. Growth stocks, as you'd expect with the AI focus, led the way, up a strong 1.0%. Value stocks barely moved, up 0.1%. And NASDAQ, as we said, really strong, up 1.6%.
Okay, so that's the U.S. picture kind of held up by AI optimism. But what about the rest of the world? Did they catch that same AI fever, or are global markets maybe telling a slightly different story about the economy overall?
Interestingly, no. International stocks actually did better last week. Developed market stocks outperformed the U.S., up 1.7%. And emerging markets were strong, too, up 1.2%. So there was definitely a broader global lift happening.
Any particular standouts in Asia that caught your eye?
Definitely. China was up 1.3%, which is solid. And Japan had a particularly strong week, up 3.8%. Even though the Japanese market was closed today for a holiday, the futures are pointing towards the Nikkei maybe hitting a record high this week. It's just continuing that impressive run it's been on.
Now, switching gears again, the bond market. It's often seen as this, wise, cryptic oracle, right? Whispering signals that maybe others aren't picking up on yet. What message is it sending us this week?
Yeah, the bond market definitely told a different story last week. Bonds actually sold off a bit. The yield on the 10-year Treasury, that key benchmark for borrowing costs everywhere, it rose 7.3 basis points, so 0.07%. It closed at 4.27%, so bonds went one way, stocks went another.
Yeah, and there was that particularly interesting anomaly that Bloomberg picked up on August 6th. something about the 5-year Treasury. What was that about?
Yes, exactly. Their analysis showed the 5-year Treasury is trading unusually expensive, which means its yield is lower than you'd normally expect compared to both shorter-term bonds like the 2-year and longer-term bonds like the 30-year. It's kind of an odd kink in the usual shape of the yield curve.
And historically, what does that specific kind of kink, that anomaly, usually signal? I mean, is the bond market trying to tell us something maybe even the Fed hasn't quite figured out yet?
Well, historically, yes. This specific situation has often correlated with much sharper rate cuts coming down the line from the Fed, much sharper than maybe anticipated. It suggests the bond market, which is always trying to look ahead, might be pricing in a more significant economic slowdown or maybe more disinflationary pressure than the current official data, or even what the Fed is publicly saying might suggest. It's like the collective wisdom of bond traders is maybe seeing a different, perhaps more challenging path ahead. For you, thinking about your own strategy, this kind of cryptic signal could suggest maybe reevaluating how resilient your portfolio is against potentially faster rate cuts than everyone expects right now.
Wow, okay. What a deep dive that was. We've really covered that tension, haven't we? The ongoing battle between that AI-driven market optimism and those underlying economic worries that just won't go away.
And that's precisely the value, I think, of looking beyond just the headlines. Understanding these nuances, from tiny shifts in unemployment claims to these really intriguing, almost prophetic signals from the bond market, that's key to truly being well-informed, not just, headline-informed.
So what does this all mean for you as you try to navigate this really complex picture? Given the bond market's weird signal and the stock market leaning so heavily on AI hope, what does it really take for a robust, sustainable economic recovery to actually take root? And maybe more importantly, where should we be looking for those next definitive clues, the ones that tell us which reality the AI dream or the economic drag is actually winning out? Definitely something to mull over until our next deep dive.